We have guest Gonzalo Cañete, Head of Global Market Strategy for ATFX Connect. Gonzalo, very good morning.
How are you, Marta? How are you? Good afternoon.
Well, the market is taking this data well. The slowdown seems to be more and more clear. And well, earlier I was also reading on Twitter that you were focusing on yesterday's movement of fixed income, especially the US 2-year bond that was above 5%. Today, fixed income is also taking the data well because yields are going down.
Yes, of course, 100%. It's the adjustment that we expected. In fact, I just posted also on the networks a few seconds ago as I was listening to you in the background. The reaction is logical. What we have seen right now, which is a drop in the dollar index, the value of the dollar after all, a rally on Wall Street and a drop in bond yields. And in fact, if I may, Marta, as I am already ahead of you because I am listening to the questions that you have asked the previous colleagues, I would like to highlight for the audience this, which is that we have that rally. That is the key here is not in the data that we have just seen, which at the end of the day adds, so to speak, arguments or justifications for Wall Street to go up. The worse the US macro data, the closer it is, or the more evident it is that the US economy is not pulling, the closer to a stimulus for Wall Street, which is what it wants. So at the end of the day, what we are seeing, the rally that we are seeing in the market is driven by bad US data, a growth rate that is 1.4, the previous 1.6, the previous one had already come out weaker than expected. So that is encouraging the market. The key is tomorrow's data. And as I was saying, which I think listeners should have on their radar, is that we had, for example, that harmonized inflation rate in Germany. It came out at 2.8. It is slightly up in Germany. And therefore, this would discount the rate cut that we were expecting from the European Central Bank that compared to the Federal Reserve, which has left them on hold. This one is not going to move them. It is not going to cut rates because it does not fit much for this reason, because we see that what is also rising is the German bond together with the US bond, which are practically synchronized. If there was a rate cut in Europe, the German bond would not be rising as it is rising along with the US bond, which is not cutting rates. The Federal Reserve is not going to do it. And as an additional issue, we have the Commodity Research Bureau Index, one of the major commodity indices at record highs, breaking highs from the pre-inflation levels that we saw in 2022. You have it on the screen. I think this is also crucial. Baltic Dry with an uptrend as well would indicate, well, that is to say, I am trying to give the signal that it is possible that these inflation rallies could be justified and that we could see that scenario that, for example, Javier was commenting on a moment ago, which is the worst one, the one you had asked about, inflation, can it happen or not? If we see that the US economy is not pulling, this is good for Wall Street, the stock market rises. But if at the same time we see that inflation picks up, we are in a dead end. Because with inflation, they cannot cut rates, and an economy that is slowing down asks for rates to be cut. So we are caught in a kind of trap of this stagflation, obviously.
It's certainly going to be complicated, isn't it? Let's see what the Fed does in such a scenario. Tomorrow, of course, the data will be very important, and we will also see if it suggests that we are facing such a bad scenario, as you said, this inflation, or if perhaps with today's data and tomorrow's data, if inflation goes down a little bit more than expected, it will bring us a little bit closer to those rate cuts. Gonzalo Cañete, thank you.
See you. Thank you. A big hug.
A pleasure, as always, to count on you, Gonzalo. We will be right back.